This conference will now be recorded.
So let me see if I can share my screen. And what we want to begin to do today is talk about the project part two. To talk about the project part two. And of course, you should have your project made and looking good, all your costs and everything laid out. So what you're going to have to do on the project for part two is you're going to have to list all your raw materials or labor. You use a bad debt of 10% and a selling expense of 20%. You can go ahead and utilize that. Your fixed costs will be manufacturing overhead, administrative, interest expense. And you've got to calculate all of those for your project. And once you've done that, then come through and fill out this table. So you're going to come through and fill out this table, and everybody will have a year that they will be preparing a budget on. So typically the team leader does the first year, then the co-lead, then the other persons on the team. And I grade the project in total, but then I grade each person's uh, budgets that they prepared that we'll be getting into the day. But you should be familiar with this now and realize you've got to prepare this for your project. Fixed costs, this is just an example of what it can look like. First of all, you need a capital expenditure budget, which lays out the equipment that you're going to buy for your business. And once you get that, you separate the cost between those that are used in manufacturing and those that are administrative. You add them all up to get your total cost of the equipment that you're going to be using in the business. You calculate straight line depreciation for the manufacturing overhead and administrative expense. And you'll use a 10% interest rate on whatever you borrow to get your interest expense. And you should plan to pay the note off in 5 years. So for your business, you got to go through and lay this out, remembering that eventually you're going to have to be dealing with some large numbers in terms of the amount that you got to make a certain profit. Then you do your manufacturing overhead schedule, your production manager, supplies, types of things that go there, rent on the building, which you're going to need. The depreciation comes from your capital expenditure schedule. So whatever you get for the depreciation, you bring that out for manufacturing overhead. With your administrative expenses, you're going to do a summer thing. Salary of the president, the CFO, office salaries, supplies, etc. Fringe benefits, typically 25% of salaries, taxes, depreciation. Once again, that depreciation number would come from your capital expenditure budget. Your total fixed cost will consist of three components. Your manufacturing overhead, that's all fixed. The administrative expense is fixed, and the interest expense is fixed. So in this case, the totals were 417,500. But you got to go through, check the financial statements on for the product that you're making, check on what the financial statements are, and then come in with numbers. Your fixed expenses in year one has to be at least 200,000, but because you got to produce more in year two, 400, year three, 600, year four, a million. So you're changing the fixed expense each year. Year one, when you're losing 100,000, year two, when you're breaking even, year three, when you're making a profit of a million, year four, when you're making a profit of 2 million. So your fixed expenses will be changing each year. So
Real
you add
quick, where's this worksheet? Is it in project two?
in project part two. So in the project part two, you got the CBP worksheet. That's part one. That's sheet one. You got fixed costs, sheet two, and then you have assumptions, which we'll be working on all week so you can get your assumptions in. But this is your product, your project. And so you got to, so every cost from now is yours. So you got to come up with your fixed costs. Then you come back to the product CBP worksheet and you come up with the fixed costs. Now, if you so desire, and if it's simpler, you can have the fixed costs the same, say 200,000 each year. If you think you're going to have problems, and if it's simpler, just so it exceeds 200,000. You can use the same fixed costs. That might make it easier. But given those fixed costs, you got to prepare this chart. Are there any further questions? Okay. So let's look at where we go from here. This out. So today we begin the master budget process, which we will spend roughly 3 weeks on. And everything we do, which we started off with calculating uh, break even, target loss, target profit. Everything we doing, you got to do for your project. Everything we're doing, you got to do for your project. So break even, sales quantity, target profit, target loss. We're continually working with that. And of course, you know that the way our inventory, the way our income statement looks now is the sales less variable cost, contribution margin, less fixed cost, net income. And so I sent this handout to you, and hopefully you had a chance to make a copy of it. I should have some copies in my office tomorrow, if that will help. But let's look at the master budget process. And when you start a company, one of the issues you have to deal with is month to month liquidity. Just like you personally have to do it, a company has to do that. And so even though you might have a net profit at the end because of seasonal fluctuations, if you can't pay your rent in the mall, they're going to put you out. So you see the paper on the windows going up sometime in the summer. for some companies because they could not pay their rent. And so the way to uh, avoid the problem of running out of cash is we have a master budget process that we go through, and we determine, if it were your a business, regular business, we do it monthly, but we're doing quarterly in the course and on your project. So you would know, okay, if I'm going to run out of money in the first quarter, then I need to have an arrangement with a bank. If you come to the bank with your master budget assumptions on cash and your income statement and balance sheet, if you have all of that prepared, then you can get a line of credit. That's what banks are there for. But if you run out of money in the middle of the year and you go to the bank, then they aren't going to lend you any money. So this has to be done ahead of time. And this is what you'll be doing with your project. Now, we need the budget period, monthly or quarterly, and we'll be doing it quarterly. We need a selling price by quarter. We'll keep that the same. Sales units by quarter, collections by quarter, total expenses by quarter. We have to know all of this. Payment of expenses by quarter, beginning cash balance, and desired ending cash balance. So we have to have assumptions on what those are going to look like. So in the problem that we're looking at, that for this company that's selling books, we're assuming that they sell 20% of their books in the first quarter, 10% in the second, 10% in the third, and 6% in the fourth. So you can see they might make a profit in the end. They may end up being short of cash in quarters 2 and 3, possibly even 1. And so we've got to show the bank, we have to show the bank a cash budget that reflects what would happen over 4 quarters. So let's assume that our selling price multiple is 3. Okay. All the sales are cash. We're making this simple. The beginning cash balance is $100,000. Your books are costing $20 a unit. That's the variable cost. That's the only variable cost you got. And all your purchases of the books are paid in cash. Your administrative expenses, which are paid in cash, are $1,000 quarterly. And the beginning and desired ending cash balance is $100,000. You start with 100 and you ending with a company with 100. And if you have to borrow, you're going to pay it back in the fourth quarter. So with this information, I want you to first of all calculate the break-even sales quantity. Then we'll determine the quarterly sales quantity. We prepare a quarterly cash budget. Then we're going to do a budget income statement and a budget balance sheet, which is what the bank wants to see. They want to see the cash budget, a budgeted income statement, and a budgeted balance sheet. Then we're going to prepare some closing interest. We may do the regular operating interest too. Then finally, we calculate the number of books that need to be sold for $1 million. So first thing I got to do is to calculate how many books we need to sell to break even. So with all your knowledge and exam experience, given this information, calculate my break-even quantity. Calculate the break-even quantity. So with this information, can you calculate a break-even quantity? Your books are costing $20. Your selling price multiple is 3. Your administrative expenses are $1 million per quarter. So that's the relevant information. So if you had that information, calculate for me the break-even quantity. Show me you can calculate a break-even. Do I have any C student who can calculate the break-even? Well, what's the formula for the break-even? We know the formula for the break-even. Y'all better have some beautiful projects. I can see that. Y'all gonna need some beautiful projects to impress me. I don't know about y'all calculations, but you got to have the original thing made, and then you have to go to get with Miriam Darden and utilize a 3D printer. So let's see if we can calculate the break-even quantity.
The quality I got was 25,000.
How did you get 25,000? How'd you get 25,000?
Oh, I
Well,
had the since it said admitted the little expense, it was 1 million, so I had did the 1 million divided by 40, and that's my CM. My CM was from my selling price, which was 60, because I did 20 times 3.
okay. So it says that we're gonna pay this rent every quarter, right? So in period 1, you got to pay $1 million. In period 2, you got to pay $1 million. In period 3, you got to pay $1 million. And in period 4, you got to pay $1 million. So what's our total fixed cost, which is this rent? How much is that going to be? Might that be for how much?
4 million. Four
Yeah, that's
million.
4 million. So let's see if we can see if I can. So the break-even quantity
Where are you getting the rent expense for the problem?
says right here, the administrative expense, which is the rent, is $1 million per quarter. Okay, so that's the rent. And we know the formula for break-even equals what?
Fixed cost divided by the unit contribution margin.
Okay, the UCM. Well, that's going to be what?
1 million divided by 40.
All right, first of all, you're paying $1 million a quarter. So it's going to be 4 million. So that's what you got to begin to realize now. And the unit contribution margin we said that was going to be what? The cost was how much per book?
$20 per book.
The cost was $20 per book. Get the UCM. So if the cost is 20, and if our selling price is 3 times that, then we're going to have what? Because you all had a selling price of what, 60
60.
minus the 20, it's going to give us a UCM of what?
40.
40. So it's going to be 4 million divided by 40. So what's our quantity we got to sell to break even?
100,000.
I'll take your word for it. 100,000.
Why did we subtract 20? Like, I get why we multiplied it with the 3, but why did we subtract it?
Okay. Our cost of the books were $20 each. Remember that? The selling price multiple was 3. So if the books cost 20, we will sell them at 60. So the contribution margin, how much each book contributes to our fixed cost and profit, is $40. Do we see that? Okay, so now once we get we calculate this break-even amount, we're gonna bring that down here for 100,000. Okay. Now we got to break the 100,000 down by how much is sold each quarter. So we'll copy these. Let me see. I'll just put those here. So now we have the percentages sold. And of course, this always adds up to what? 100%.
100.
Let's look at the first quarter. If we sell 20% of the million, how many are we going to sell? How many books we going to sell?
Said 20% of the million.
1,000, yeah. We might sell 20,000 books that quarter. It's 20% of the
10?
total. So what?
My bad. I thought we were looking at number 2.
No, we aren't going there yet. Our selling price is what?
60.
So what our total sales going to be?
1.2 million.
take your word for it. In our beginning cash, we said we starting with 100 and we want 100 in the bank all the time.
I'm sorry, why is it 1.2 million?
Somebody multiply 60 times 20,000.
Okay, thank you.
So how much cash do we have available? We got our cash sales in the first quarter plus the 100, so we got 1,300,000. Now we got the books, buy the books. We're paying cash for them. So how many books we got to buy? We're selling 20,000.
20,000,
And what's the cost of the books?
$20 each.
So that's going to be what? 400,000.
Yes.
And so our total disbursements are 1,400,000. So we needed 1,300,000, but we only have we got to pay 1,400,000, and we only got 1,300,000. So this is where this budget comes into play. If you had not made an arrangement with the bank, you would not be able to pay all your expenses. You know what happens if you pay part your rent, right? What happens if you pay part your rent? You go to your landlord with part your rent, what's going to happen? What do you think's going to happen? All y'all have y'all rent. Okay, we're short 100,000. Our ending cash balance has to be 100,000. You know, you're running the company, you got to have so much money in there. So how much do we need to borrow? How much do we need to borrow? We're short 100. We, we need 100, so we might have to borrow what? 200,000. Now, if we've made, I think I got it on the wrong line, excuse me. If we've made plans for this ahead of time, that's fine, but if not, so this is why you prepare this budget. Now, let's go to quarter two. You only sold 10% in quarter two of the books, so that's 10,000.
Is it always gonna be double the what you need, the
No,
loan?
no, it depends on what you need. Let's go to quarter two.
Okay.
You got 60 is your selling price. So how many, what's our total sales going to be in this quarter?
600,000.
Our cash, whatever we had down here, that becomes our beginning cash the next time. So we only got 700,000 in cash. We buy these 10,000 worth of books at 20 each. We got to pay what? 200,000 for the books. And so our total disbursements are 1,200,000. So now we're short how much? 500,000. How much we got to borrow now? If we want this number to be 100,000, you got to operate your
600.
Can you
so
explain where you got the excessive cash available again?
we simply look at what's the cash available and what's the total disbursements, and so we subtract what we got available and what we got to pay. So this line 700 subtracted from this line.
Got you.
All right, you all do quarter three. Time for you all to see what quarter three is going to look like.
The end cash, is it always supposed to be 100,000?
Yep, always got to be. And you have an assumption, but when you're running a business, you have to have a minimum amount of cash. Okay, so that's what Donald Trump was saying. I might have 400 million, but I have to have you know 100 million, 200 million in the bank all the time. So a similar thing here. If you're running a company, you got to make payroll and all of those kinds of things. So you can't, you know, when you're working, when it's time for pay, most of y'all want your money. Maybe we have one person in here who said that's okay, you don't have the money. But most people want a paycheck. And so you can't be waiting for the sales, so you keep a certain amount of money always available. Any questions? Y'all got three done?
Yeah.
It,
So
is it just
what's
the same thing?
Yeah, that's what I got. The same exact thing.
all right, so it's
Yeah, me
10,000,
too.
selling price is 60, total sales 600,000, getting cash 100,000, all of that's the same. So the cash available is 700,000. Book's gonna cost you 200,000 again. Total disbursements 1,200,000. So you short 500 again. So you'll have to borrow 600 again. So you start off with 100,000. Fourth quarter finally comes. We're still in business and we sell 60% of that quantity now. Calculate the fourth quarter and tell me what it's going to look like. Calculate the fourth quarter and tell me what it's going to look like.
To get the short-term loan, you just did the ending cash added to the excessive cash available to see how much we would need.
Right. We would get the difference and then we'd add the ending balance that we needed to come up with what we would have to borrow. That's correct. So this is the type of budget you got to prepare for your project. So you see why, we spent this time working with break even, target profit, and target loss quantities. Because if the quantity is incorrect, then this whole table would be incorrect. You all got the fourth quarter done yet?
Yeah,
Yeah.
All right, so how many we selling in the fourth quarter?
60,000.
Selling price is what, 60?
Mm-hmm.
So it's our total sales.
3.6 million.
Beginning cash was still at 100,000. So the cash available is what?
3.7 million.
How much our books gonna cost us?
1.2 million.
So take your word for this, 1.2 million. So our total disbursements are what?
2.2 million.
So what's our situation in terms of cash in the fourth quarter?
The 1.5 million.
You had cash available 3,700,000. You got to pay out 2,200,000. So how much cash you got now in this fourth quarter?
I put 1.5 million.
1.5 million.
Correct. One. You never get to this point if you don't have these loans. So let me put my parentheses over here. So how much had we borrowed?
1.6 million.
600,000, 600,000, and 200,000. So how much had we borrowed?
Are you asking for the total for the past 3 quarters or all 4 quarters?
3 quarters.
1.2 million. Oh, not me. 1.4. That's what I got. At least.
1.4.
So we got to pay that back, right? Bank's going to want their money back. So the owner ends up with what? His ending cash is what?
100,000.
Why is it 100,000? You think?
Because that's their budget cash.
Remember, this is a break-even year, okay? So when we break even, if we add up all of these sales, how much are the total sales? We add all 4 of these up.
Is it 6 million?
I'm gonna take your word for it because it's 60. Then if we add up all of these cost of books, how much was that? That 2 million? So the total sales
The total
equals
sales
total.
is wrong.
Say what?
The total sales is wrong.
How much is it? Y'all told me.
Is it 2.2?
All right, 1, 2, 6, 6, and 3, 6. How much is that?
Oh,
Add all of those up. How much did you get?
We're talking about cash available, right?
I'm talking about total sales right now.
Oh, total sales. Yeah, I got 6 million.
You
Okay,
sold
never mind.
100,000,
I was right.
6 to each, so 6 million. Your disbursement, your cost of books sold and rent expense was 2,000,004. And so all you have is 100,000 because that's what you started with, and you broke even. Any questions? Okay, so we got the cash budget done. This is what it looks like. So the banker says, okay, I see that. I want to see the income statement. And we just prepared it, right? The sales were what? 6 million. The cost of books sold was 2 million. And the administrative expenses were 4 million. So the total expenses were 6 million. And the net income was 0. So we broke even. What's our balance sheet gonna look like? We can say at the end of the period, our balance sheet is 100,000 in cash. So our total assets are 100,000. For the stockholders' equity, we only have what we started the company with, the 100,000. So the total liabilities in 100,000. So our balance sheet is balanced. Now, now to get these things done that we need, we have to make journal entries. Okay. So we did it in our head, but since you're gonna have to work this million one, the first thing we did, we started our company with 100,000. So we would have made a journal entry, everything cash, crediting common stock, for $100,000. That's the first journal entry we would make because we started the cutting with 100,000. Then we would have recorded our sales. So since
Wait, so
all,
why is there 3 columns?
let's see, count.
Is it put in wrong? Because it says
Let me put it,
credited on the left side.
let me just, let me put, the 100,000 here. That way, account debited and the account credited would be common stock. You can do it either way. So that's the first entry. Then we would make the sales entry where we're going to debit cash and we're going to credit sales. And what's that credit? What's the amount that's going to be? 6 million. Because we sold all the books, we would simply debit cost of goods sold. We credit cash, sell of those books, and that was 2 million. With your projects, you're going to have to make these journal entries. And finally, we paid the rent, which is the administrative expense. I'll just put administrative expense. And we said that was what, 4 million, correct? And we would credit cash 4 million. Put it here. Okay. When we go ahead. Yes,
Real quick, can you post this video? I do have to go to work, but can you post the rest of the recording, please?
I will attempt to do that.
All right, thank you. You have a good day.
You too. Okay, so when we borrowed the money, we would debit cash and credit the short-term note. And we borrowed how much money? We said 1,000,004. And then when we paid the note back, we would debit the short-term note and we would credit cash for the 1,000,004. Okay, now we need to make these closing entries. And because you're a year, because you're going to do 1 year, then the next year, then the next year, uh, you're going to have to close your accounts out because those permanent accounts carry over, but the others don't. So, of course, the first closing entry is always what? Sales. We debit sales, and we credit income summary. And that was 6 million. Then on this next one, this closing entry 2, we would close out the expenses. So now we're going to debit income summary. And that would be for 6 million. We're going to credit the cost of the books. We said the cost of the books was 2 million, correct? And then we have the administrative expense. And that amount was 4 million. So that's what you're going to have to do. You make the journal entries and post to the ledger to get your financial statements. Then you make the closing entry to close that year out. Are there any questions? Okay, let's look at the last thing that we were tasked with doing. Let's look at the number of books that need to be sold to produce a profit of 1 million. And then prepare the cash budget, the income statement, and the balance sheet. So what I want you to do is do the same thing that we just did. I want you to do the same thing, but you're doing it when the target profit is $1 million. So we'll keep all of these things the same. But of course, you're going to have a different quantity. So I
You said
want
target price of 1 million, right?
the target profit is 1 million.
Okay.
So the first thing you got to do is to come up with a quantity, given that the target profit is 1 million. Then you got to go through this process again. Hopefully you won't need to borrow.
It's all the same percentages, right?
Correct.
Okay.
So hopefully you're seeing how your project would look. You do this first for break even. I may just start with break even. Then next you do it with a target profit of 1 million. Do we have a quantity yet?
I got 125,000.
So you're saying the quantity is 125,000. I'll take your word for it. What was your total fixed cost?
5 million, and then I divided it by 40.
Your total fixed cost is how much?
It's like from the 4 million, I
Right.
was going off of we still doing that, and then plus the 1 million.
Okay. Does everyone have that? So I want everybody to plan to turn this in next time. This will be a 5-point attendance quiz. With everything I did, I want you to do. So you got to complete this cash budget. Got to make closing entries. You got to make your regular journal entries. I want to see the balance sheet. You got the one for break even, put it last. The income statement, put it right there. So is it clear what I want?
So you want us to do all these charts for our product by next, is it next class that is due?
No, I didn't say anything like that. I said on this
What did
problem,
you say?
on this problem,
Uh-huh.
where it said that calculate number of books to be sold to produce a profit of $1 million, that's all we're working with. So what I want you to do is working with that $1 million, complete this cash budget based on $1 million, make my journal entries, let me see a balance sheet and a target profit income statement and a balance sheet reflecting that million. So you aren't working on your project, you're working on this example. Got it?
Got you.
So this will be a 5-point attendance quiz for you to get everything done. And eventually you're gonna have to do something similar to this with your project. So I'm giving you a template and hopefully get the understanding. So we'll see in terms of how this would look in a simple situation like this. Now you'll be doing your project quarterly.
I'm still kind of confused on the quantity. So how did he get 125,000?
Tell them how you got 125, Robert.
All right, so I took the 4 million from when we had like the last problem, and then I added the 1 million, so it gave me 5 million, and then I divided it by CM, which is 40, and that's how you get 125,000.
So you're right. We're in the target profit situation now. And so we're going to take what? Same UCM, but it's the 4 million fixed cost plus the million in profit. So the 4 million fixed costs plus the million divided by the UCM, which is 40. So you got to memorize those formulas and know how they work. As we said, so let's see if we can get through the first quarter. So we noticed numbers 125. So what's 20% of 125? What's the quantity sold going to be?
25,000.
Selling price is 60. So what's our total sales going to be?
1.5 million.
The beginning cash is $1 million. So we got what? A million.
1.6 million.
We still got to pay the rent, the administrative expense of $1 million. How much are the books going to cost us?
2.5 million.
Not that much, is it?
That's what I got. 125. Wait,
25,000.
wait. That's me. 5,000 times 20. 500,000.
How much?
500,000.
Take your word for it. So our total disbursements will be what?
1.5 million.
So now we got excess cash. We doing so well. We got excess cash of how much?
Of
100,000.
negative 100,000.
Why is it negative?
Oh, never
Yeah.
mind. Yeah, positive.
So how much you gonna borrow?
0.
Zero, because you got 100,000. Does everybody see the $1 million year in that first quarter? So what I want everybody to do is to finish up all 4 quarters, make your journal entries, prepare your balance sheet, your income statement and your balance sheet, and make your regular journal entries and closing entries. It's not that many. The entries are going to stay kind of the same. I'll probably try to save this document and put it in course content. So the journal entry is going to virtually stay the same, but we may not be borrowing because we're making money. Any questions? Okay, so I want you all to work on this. We'll go over it when we get to class. And then we're moving through the managerial process for a master budget, which is a little more complicated because you're making something. So you got a lot more categories. So it won't be quite this simple. But you need to look at the handout. I've asked the secretary to make copies, so I should have some in my office. Otherwise, you just go through and, burn your copy so you have it. It's going to be easier if you got that hard copy looking at it. Okay? So you all have a good rest of your evening and go through and finish this. And this will lead to what we're going to be doing with the project. This leads to what we'll be doing with the project itself. And so you got to have your project made now, all your costs together and everything, because you have to do this based on the cost in your project. Okay? Any final questions?
Yeah, I have a